How do you calculate a tax provision? Have you ever wondered how companies figure out their tax obligations? Today, we will break down the process of calculating a tax provision in a way that is easy to understand. A tax provision is essentially an estimate of the income tax a company expects to pay within a specific period, usually the current year. This estimate is reported in the financial statements and is crucial for accurate financial reporting. To start, you need to look at the pre-tax income according to generally accepted accounting principles. This is the income a company has before taxes are applied. You can find this figure on the financial statements, calculated as total revenue minus total expenses. Next, you will want to adjust for permanent differences. These are items that impact either book income or taxable income but not both. For example, fines or tax-exempt income would be included in this adjustment. This step helps reconcile the book income to the taxable income. After that, you need to adjust for temporary differences. These arise when income or expenses are recognized in different periods for book and tax purposes. A common example is the difference in depreciation methods used for financial reporting versus tax reporting. The net change in these temporary differences will affect deferred tax assets or liabilities. Another important step is accounting for loss carryforwards and tax credits. Loss carryforwards are losses from previous years that can offset current taxable income. Tax credits can also reduce the overall tax provision, so be sure to include these in your calculations. Now let's calculate the current income tax provision. You will multiply the adjusted taxable income by the applicable tax rate. For instance, the federal tax rate for C corporations is currently 21%. This will give you the estimated current tax expense. Keep in mind that adjustments may be necessary for prior year returns and any uncertain tax benefits. Next, we need to calculate the deferred income tax provision. Deferred tax assets and liabilities are recognized based on temporary differences. The change in these accounts from one period to the next will determine the deferred tax expense or benefit. Finally, to find the total tax provision, you simply add the current income tax provision to the deferred income tax provision. This gives you the total tax provision that will be reported in the financial statements. Additionally, it is wise to perform a return to provision step. This step reconciles and adjusts prior year tax provisions to match the actual filed tax returns. This ensures that your financial reporting is accurate and reflects the company's tax obligations for the period. By following these steps, you can effectively calculate a tax provision. This process is essential for preparing financial statements and ensuring compliance with accounting standards. Understanding how to calculate a tax provision helps companies accurately reflect their estimated tax liabilities, which is vital for both financial reporting and planning.